Hi, I'm Mandy Bankston. Welcome to Wander and Balance. We are here today and we have a very special guest. We're going to be talking about some accounting strategies, tax strategies, and just for your small business as a travel agent. And our special guest today is Nick Grantham. Nick works for Nifty E. Sullivan CPA, or actually now it is Sullivan and Grantham. I understand there's a name change coming. And Nick is a CPA. He's been doing tax. He's been in tax for about 5 years. And before that, his original degree was in marketing. So he's got a lot of business experience in marketing and running. And he worked for a valet service out of that. Well, he was the marketing manager for a valet service at an airport. And just a little fun fact, he was also one of my first travel agent guests. I got the pleasure of helping him plan his honeymoon in Aruba.
Yes, that was a great trip. I highly recommend Mandy as a travel agent. We had a great time. Aruba was unlike any place I've ever been. It was awesome. Thanks so much for having me on, Mandy. And I guess, just to give a little background or expand on that, my original degree was in marketing. I worked for a valet service at the airport, and I helped to actually submit bids to additional airports to try and grow the business, and also our event valet business, which we successfully grew during the time I was there. And then around COVID-19 and all of that fun time, that's really when I made my career shift and went back and got my accounting degree, and more recently became a CPA. And so I've been in tax and kind of nose down in the tax world now for 5 years, and really enjoy it, really enjoy the different strategy that's involved in kind of trying to help clients to maximize their savings. So yeah, I'm loving the accounting world.
Great, welcome. Yeah, 2020 was rough on the travel industry, all of us. I was just getting started, kind of like you, and 2020 was going to be my big year for travel, and it almost took me off.
I'm glad you survived it though, because seems like now we're finally getting back to a good boom in that travel world. So we're fine. Hopefully we're through that for good.
Absolutely. Well, we'll jump in and we'll talk about some tax strategies for small business owners and some general organization tips for a small business owner. I am a small business owner and a CPA and a travel agent. And so hopefully our tips will be good, not only for travel agents running their own business, but other small business owners. And, the focus of my channel is both, because I do both and I love both. And so hopefully you'll be able to gather some insights if you're a small business owner. Even if you're not in the travel industry, but you're a small business owner and you travel for business, how do you maintain your business and go wander the world and maintain that balance without your business falling apart while you're gone? Hopefully we'll offer different tips. And on this episode, we'll have your tax strategies as a small business owner. So thank you for joining us.
I'd love to dive right in and kind of hear about what are some of the best deductions for small businesses that people maybe don't often think about or don't even know are out there for them.
One is the home office deduction. That scares a lot of people. They think, people are scared of the IRS and they don't want to do anything illegal. And obviously, as CPAs, we would never encourage anybody to do anything illegal. But there are a lot of tax advantages that you can and should legally take advantage of, and the home office deduction is one. I'm a small business owner. I work from home. As a travel agent, I know people tend to just work from wherever, but I really encourage people, find a designated spot where you work. Whether my kids are grown, they're out of the house, so I have a spare bedroom, and that's my office. And when we were renting, if we had like 1,300 square feet of a kind of apartment, and 100 square feet of it was my office. And so I wrote off 8% of any expenses we have for renting that house. This is legitimate. This is good. And you're not cheating. So if you're working from your kitchen table or you're sitting on the couch with your laptop in your lap. I'm saying, you're going to be more productive anyway. Designate a spot. I've had people designate an overgrown closet, a big walk-in closet, turn it into an office, just a spot, even if it's just a cubby in your kitchen, create a little bay window area and right off that space, whatever you can do. But it's good for your business and it's good for you, and it's a tax deduction.
Yeah. So with the home office deduction specifically, people may not realize this. There are two methods even to calculate it. And so I'll explain those. The first method is really, it's just based on square footage. It's called the simplified method. And that's where you would take your home office space, and maybe it is a closet or a bay window or it needs to be a designated space exclusively and regularly used for business. But you would take that, and let's say it's a 10 by 10 space, that's 100 square feet, and you would multiply 100 times $5 per square foot. So in this case, if you wanted to just elect the simplified method on your tax return, you'd get a $500 tax deduction against your business income for this home office deduction. So that's nice in terms of simplicity. However, a lot of times what's going to be a lot better is taking the actual method, and that's going to be where you really calculate all of these home expenses like you mentioned. So mortgage interest, property taxes, electric bill, water bill, trash bill, utility bill. You take maybe improvements to the home that indirectly affect the home office space, and you multiply those by the ratio of that home office space. So you'd say 100 square feet is my home office divided by 2,000 square feet for the whole home. You'd get that ratio, that percentage, 5% multiplied by all of those expenses for the year, and you'd come up with a deduction. Now, another item that people don't often think about is you can also take depreciation. So you can take, my home costs $300,000. Let's divide that by 27 and a half years. Take about 1/27th of that times the 5%, and you get that also with your home office deduction, that depreciation piece. So yeah, definitely the home office deduction can be huge. So that's a great one.
Okay, yeah, and when we're kind of transitioning from home deduction, another thing that is kind of related to that when you're working from home is the technology purchases, furniture, decor for your office space. And so one thing that I need a little more clarification in is the decor, because I've kind of heard that certain things aren't really deductible, certain artwork and stuff like that. So could you expand on that?
Yes. So when it comes to decor, artwork, things like that, it's not going to be deductible if it's not directly or indirectly used for the office space. So for it to be qualified as a business use, you would need to be able to justify that the artwork, for example, or decor is placed in that specific area that's regularly and exclusively used for home office space to help the environment, essentially, help create a business environment, if you will. If you're just buying artwork for like your living room, then that wouldn't be something that you can justify as a home office deduction. It would need to be in that home office space. Now, if you have a specific office building as part of your small business, maybe you have a totally separate building office space that's 100%, for your business, then any of that decor obviously is deductible. So couches, furniture and fixtures, artwork, different wall art, those things would be 100% deductible. But if we're speaking on the home office, it would need to basically be part of that home office space, making the environment business-like.
Okay. And I think of behind me, I've got all my travel pictures everywhere, and so everything. I mean, that makes for my travel environment. When you think of that,
They do have some limitations on like what might be considered like valuable and treasured art. So maybe more like collectible items that, really expensive collectible items, that's not really going to be business related. It needs to just be like normal decor, that relates to the home office space. But if you're going out and buying, a $30,000 collectible piece of art, that's going to be something that you may not be able to justify as has a business purpose. Does that make sense?
Yeah, no problem here.
Okay.
I'm not going to spend $30,000 on an art. That's just me
Yeah,
though.
me neither. Another thing, you had transitioned into the technology piece. A lot of our clients don't think about internet, so for example, their internet and cell phone, those two specifically, those are items that can be deducted at their business percentage, so if you're using your cell phone 50% personally, but then 50% for your business, well, we can deduct 50% of that cell phone as a business expense. So those are a couple other things we see a lot of times that clients don't think about. So I always like to mention that. And then obviously like things like laptops, maybe the cost of a cell phone, different pieces of technology, those can be deducted as well.
All right. And then, so another thing that's coming up on the end of the year when we're recording this, we're right before Thanksgiving. And so a lot of business owners may be thinking, when should I make these purchases? You might need to invest. You might need a new laptop. You might need recording equipment to make all those fun travel videos or so now might be a good time, you think, to invest in that?
Yes, definitely. If you're looking to maximize your deductions and you need certain equipment, whether it be a new phone, a new laptop, office equipment, things like that, it's going to be in your favor generally to buy that before the calendar turns into 2025 because you'll be able to take that deduction sooner, and get those tax savings sooner. So yeah, I think that's great advice to anyone who's watching this and they've been kind of throwing around the ideas of purchasing new equipment for their business. Now would be the time to do so. This next topic is a really great one for travel agents, so I'd love for you to dive in a little bit. But travel costs. Travel costs is a business expense that sometimes, again, people don't really think about it, whether it be going to a conference, whether it be going somewhere to, check something out for clients, for example. Could you give us information about deducting travel expenses and how that you've seen that work with your clients and in the travel agent industry?
Yeah, absolutely. This is another one that typically scares travel agents. They think, well, I can't write off my travel, but you can. You just, again, you need to do it the legal way. But as a travel agent, we travel. And all of us are always working, even when we take family vacations. We're always working. Again, I can't go take my husband and my grandbabies and go to Disneyland and write off the whole thing when I'm just being a pleasure. But I might go and observe it and do some site inspections at the hotel. And so my portion of that travel, of that trip, or I'm investigating all of the ways to get your tickets for Disney World, or all of those things. That is deductible. I'm researching for my business. I'm doing a FAM trip, which we call familiarization trips, and travel agents are all aware of that. We also do site inspections. To go visit a resort, and I love selling all-inclusive and staying in all-inclusive in Mexico. So I've been to several resorts, done my research. We'll make appointments with the sales manager there. They'll give us a tour of the whole resort. They give you a lot of insider tips and contacts that are value added to our travel clients. And so that trip is written off.
Yeah, and I know with travel, just to clarify, when it comes to tax returns, maybe you do have a trip that's business related, but it's also a vacation. You're kind of doing a little bit of both. So the way that would work is if there is a business purpose in there, your airfare is fully deductible. But in terms of like your meals or your hotel stays, you're only going to be able to take the days that are related to business. So if you're there for 2 days for a conference and then you're there a total of 5 days, so then you've got 3 days that are personal afterwards, you would be able to deduct the 2 days hotel, on those business related days, for example.
Okay, good point. Good point. And if my husband goes with me, unless he works for me, I don't get to write off his side of that either, correct?
Correct. However, for small business owners, this is actually a great tax strategy that we can talk about. But if your husband was on your board, for example, or if he was, if you guys were partners in this business, for example, then all of a sudden, if you guys are going to a restaurant and you're discussing the business, you're having a business meeting, you're traveling together, and you're both going to, research and work together on this travel agent, well, then all of a sudden you can deduct your husband's piece because he's maybe an officer or on the board, or, you guys are partners. So in this case, that'd be a way that you could structure your business so that you can deduct each piece.
Okay. Nice. That's a good point. And then you mentioned meals. So how do the meals work? We do a lot. I work from home, so I don't meet with clients. They're in my office, so I'm constantly meeting them at coffee shops or restaurants.
That's actually a great question. And really, if you're having a meal with a client like that, then it's a deduction. However, you only get to deduct 50%. The IRS, views a meal, even if it has a business purpose, it still views it that it's, always a little bit personal because everyone has to eat, right? You at least get a 50% deduction, so the way the meals work is it needs to have a business purpose, taking a client maybe to a meeting, maybe taking, if your husband is an owner of the business with you, you guys are partners, and you're having a meeting that's business related, then that would be a deductible meal. However, it's also important that you save those receipts. On the receipts, write down what was the purpose of the meal, to have justification that it was a business meal. But then if you're ever audited by the IRS, you have those receipts, you have the business purpose written on the meal receipt, and it's a 50% deduction. There are actually a couple options for a 100% deductible meal, and the most common would be some sort of team building event, so for example, if you had some employees that worked for you and you threw a team bonding, event of some kind, or like a holiday party is another example. Thanksgiving's coming up. So maybe if your office has a Thanksgiving holiday, party or team building event of some kind, then those meals can be 100% deducted. So another thing we kind of hit on earlier about the traveling was conferences. In a lot of industries, business owners may have conferences that they sign up to go to, and they have to travel across the country. And so those are obviously deductible as well. Mandy, do you ever have like travel conventions of any kind that you go to or any of your clients go to?
Yeah, absolutely. I'm a member of a host agency, and so my host agency has several seminars, conferences throughout the year that I travel to. They're never here in Texas. Sometimes suppliers offer training. A popular thing with cruise lines is to do seminars at sea when you're on a cruise, but pretty much every day of your cruise, you're going to a training session. So there's lots of conferences and things like that.
Yeah, so that's a great one. If you're in an industry where you're getting the benefit of writing it off, but also the benefit of the knowledge from and networking from the conference. So yeah, that's a great deduction for a small business owner. With all these strategies, another one that really ties in well would be a family business or employing your children, if you're a business owner. So specifically employing your children is a great deduction that people don't think about. And the way that works is if your child is under the age of 18 and you as their parent are employing them, then they do not need to withhold Social Security and Medicare taxes. So what that means is you can pay them up to the standard deduction each year. For 2024, it's a little over $14,000. For 2025, it'll go up. It goes up every year to adjust for inflation. But basically what that means is you can pay them out of your business for work that they do for you, and they do not need to file a tax return or pay a dime in taxes as long as their earned income is less than the standard deduction. So what we often tell clients who are business owners that have, children, we would say, hey, instead of earning this money, paying your taxes, and then using that money to go buy your children toys, to save for their college, things like that. Instead, let your children work for your business. First of all, it's going to allow them to gain, crucial knowledge and work ethic that they're going to, value for the rest of their lives. But also it allows you to get a tax deduction, and it allows the kids to earn money themselves to save for college and things like that. So that's a great deduction.
Yeah, absolutely. And chances are they're helping you anyway,
Right. Mm-hmm.
The kids are great at the social media, the marketing, cleaning the office.
Yeah, cleaning the office, organizing paperwork. Maybe you have a business where you get a lot of phone calls. Maybe they can help answer the phone or check voicemails. There are all kinds of things that they can potentially help with. And so the big things with that deduction is, you want to justify that you're paying them a fair, reasonable wage. You can't pay them $10,000 for one day of work, for example, for answering the phone one day. It needs to be an actual reasonable rate. And then they need to have some job duties outlined, something on paper, an employee agreement. And also the big one too is you want to transfer the money into a bank account for them. If they're young children, you can set up a bank account, in their name, but it's under like your umbrella. The bank can help you do that. And, if they're really young children, you might be thinking, well, this is a great idea, but my kids are, 3 and 4 years old. Well, potentially they can do modeling for the website. At 3 years old, maybe you can help them. You can start teaching them how to help you, tidy up the office or clean, organize paperwork. That's pretty young. So modeling a lot of times is the best one for really young children. But any little bit counts, So even if you only pay them a couple $100s for the year, that's still a deduction for you. So it's really well worth it, to keep up with that and take the extra steps to take advantage of that. Another deduction would be insurance. Could you expand maybe and dive in a little bit on that and kind of maybe in your business, what type of insurance you're deducting, for example?
Sure. Some of the insurance, like for me, is covered by my host agency, but then a lot of agents, as we expand, we get our own E&O. Insurance is a very important insurance to have. So for that liability for your insurance, and then you have health insurance, you have cyber insurance, those things, and health insurance premium for self-employed. Could you expand on that, on the deductibility, the types of plans, and how that works, the best way to set that up? Health insurance is a big deal when you're working for yourself.
Definitely. Yeah, when you're self-employed, if you're paying for health insurance premiums out of your own pocket, which most of the times you will be since you don't have a W-2 employer that's, that the health insurance is through, you actually get a deduction for that. So yeah, when you're self-employed, we definitely want to know how much you're spending on your health insurance. If you're a sole proprietor, it's not going to go as a direct deduction on the Schedule C. However, it's an adjustment to your income on your tax return. So you'll get a deduction for the amount that you paid out of pocket for health insurance. And it helps to bring down your income essentially that you're taxed on. So it's very important to keep up with that. That's something that your accountant is going to need when they're working through your taxes. So that's a great deduction. Another, piece of insurance that people may not think about would be vehicle insurance. If you have a business vehicle and you're taking the actual expenses like gasoline costs, depreciation on the automobile, repair and maintenance on the automobile, well, don't forget about your vehicle insurance, because then that's going to be deductible as well. And if it's not 100% business use vehicle, at least a portion of it is still deductible, maybe 50%, 75%. So that's another insurance deduction that people aren't always thinking of.
Is that in addition to the standard mileage, if you're taking standard mileage?
Unfortunately not. We can only take one or the other. So, a lot of the times the kind of rule of thumb would be if you have a vehicle that gets really good gas mileage and maybe it's less than 50% business use, then a lot of times the standard mileage deduction will be better, because that's where you're just going to take the mileage driven for business, multiply it by 67 cents per mile, and that's going to be your deduction. So if you drove 1,000 miles for business, but you drove 10,000 miles total, well, then only 10% of your mile, only 10% of that vehicle is deductible. So in that case, a lot of the times, taking 1,000 miles times 67 cents, that's going to give you that $670 deduction. That's probably going to be better. Now, when it comes to the actual method, then a lot of times if you have maybe a truck or a more expensive vehicle that doesn't get as great of gas mileage and you're using it more than 50% for business, then a lot of the times the actual method will be better, and that's where you still look at the mileage to come up with that business percentage ratio, but then you multiply that percentage by the cost of your fuel, the cost of your insurance, the cost of repair and maintenance, and then you even take your cost of vehicle and you can depreciate it at that percentage as well. So a lot of times, we'll look at it both ways if we're doing your taxes to see what's going to be better. But ultimately, you do have that option one way or the other.
So for small business owners, the best tip is to just keep track of that kind of stuff. Keep track of your miles. Let the professionals figure it out in the end, but just do the good record keeping and keep all of these things in mind and the things that are deductible. You're driving to meet clients. You're driving to the airport for a fam trip, for a conference. You've got mileage on your personal vehicle, even if you don't. I would think typically as a travel agent, you don't really own just a business vehicle. It's going to probably be used for both. So we're doing a lot of our work from home, or we're getting on a plane and going somewhere. Unless you do domestic trips, you might have a vehicle that way. You're also a tour operator.
That's true, yeah. So that's kind of our big advice is good record keeping, and that ties into so many different deductions, whether it be the mileage, the meals. There are just so many reasons why record keeping is important, and really that kind of brings me into a topic that I'd like to bring up to any small business owner, whether you're a sole proprietor or an LLC, however you're set up. It's always beneficial to have some type of accounting software or a way to really keep up with every single expense. And so a lot of our clients, we get them set up on an accounting software where they can connect their bank accounts, to the software. So every single transaction that goes through that bank feed is in the accounting software, and all we have to do is categorize those. And so we're not potentially missing anything when it's tax time because everything's in that accounting software. But that kind of brings up an interesting point about bank accounts, for example. If you're an LLC, then when you create that LLC, you're going to have to create a separate LLC bank account. But a lot of our clients end up just starting out as a sole prop, and they're just kind of doing a side gig and they don't really have anything formal set up yet. And so in that case, you can use a personal account for the business, but it is so worth it to go to the bank and create some separate bank accounts so that you can kind of keep things separate. Don't you think so, Mandy?
Absolutely. I even as a sole prop, all of my businesses that I started out were sole proprietorship. And, when you first start out, you have everything intermingled and you just do it. That's not the advice that I give. But as soon as you start going, okay, this is really a business, just open that business account. You go get your DBA, the bank will open that account, and you need to keep them separate. Same thing with your credit card. So you want a business checking account. You want, at the bare minimum, you want a business checking account and you want a personal bank account, and just keep them separate. Even if you're using something like QuickBooks Online and you're still pulling the transaction in just because it's easier, everything that's on this bank account is business, and you don't put anything on there that's personal, and everything on this account is personal. And then I totally recommend doing the same thing with your credit card. It makes sorting it out so much easier, and you don't miss all of those deductions. In the end, when you're trying to organize your expenses. And I also recommend you don't wait till the end of the year to organize them all. You have them going. Another thing is to set up, when you are a sole proprietor, you have to make quarterly tax payments. So I always recommend setting up a tax savings account and just do, like with my bank, personally, and I think most of the banks can do it, you can just do an automatic sweep. So every time I make a deposit, a certain percentage of that deposit goes into a tax savings. I'll take a certain percentage into here for my tax savings and a certain percentage into another savings account that I have as an emergency fund. So I like having an emergency fund personally for your business that can cover 3 to 6 months of expenses for your business savings. So again, bare minimum checking accounts for business and personal, but then you really need those other 2 savings accounts too that are business related. You may want some other, personal savings and all of those things too, but to keep your small business running, you really should have some emergency funds, especially in the travel agent world. It's up, it's down. Wave season hits and everybody's buying travel, but then we don't get paid until those people travel. So you're going to have those months where you don't have that income coming in, and if those months last quite a bit, you've got your emergency fund to fall back on and get you through when you still have the same bills every month, but not the same income or cash inflow.
Like we said before, even if you're a sole proprietor and you're not required to create those separate bank accounts, it's just going to pay dividends, by doing so, because you're going to ensure that you're not missing deductions, and, you're going to end up saving money by making sure that you're taking every deduction that you have available. That kind of leads me into another topic, which is choosing the correct business type or structure. The sole prop or DBA is great as you're just getting started because of how simple it is. But, one thing you're kind of missing out on there is the liability protection. So even though it's really simple, sometimes creating an LLC or a corporation is going to be the right move for you because you're getting that liability protection.
Can you expand on that, what that means? I get that question a lot. Like, why do I need an LLC?
Yeah, that's a great question. So, a sole prop is, like I said, it's great when you're just getting started because it is very simple. But the negative there is, you personally are the business. So you're liable for everything, basically. And we're not lawyers or attorneys, so we can't really give legal advice, but what I will say is when it comes to like an LLC, for example, when you create the LLC, you're essentially limiting your liability. You're helping to separate the business from you personally. So in terms of getting, like if somebody tried to sue you or something, you're giving yourself a wall to help with that because you're separating out your personal assets, your personal bank account from the business. And so when you create an LLC, for example, that's why you're going to have to go to the bank and create a business bank account. And then it's very important once you do so, that's why you're not intermingling personal and business funds. Everything needs to be separate books, separate bank account for the business. That's why we would recommend an accounting software to make sure that you're keeping those records and everything separate from personal. The other benefit to an LLC for tax purposes, an LLC can elect to be taxed as an S corp. So a lot of the times what we see is you have a sole prop, for example, you have a sole proprietor, maybe they're just a DBA, and they start doing really well, and so they start making a lot of income. Well, all of that income is called self-employed income, which means it's subject to Social Security tax, it's subject to Medicare tax. Those two are 15%. Plus your normal federal income tax. So sometimes if you're making enough money, like you're getting taxed essentially like 40%. Whereas if you create the LLC and elect to have it taxed as an S corp, you can split that income into 2 different buckets. And so you have your self-employment income and you pay yourself a reasonable salary out of your S corp. And that's obviously subject to the Social Security and Medicare. That's being withheld every time you run payroll, just like as if you were an employee, because you are an employee and you're running that payroll for yourself, and it's withholding those payroll taxes. But then as your business makes more money, that additional money you can take as distributions to yourself, and that gets to dodge essentially that self-employment tax. So you can save 15% on that amount that you're making in excess of your salary. So it ends up being a great tax strategy as your business really grows. So we see a lot of clients, set up the LLC, and then maybe after a couple of years, as their business's net income is increasing and increasing, they elect to be taxed as an S corp, and then they set themselves up as an employee in their business and run the payroll, and they start saving that 15%. So it's a huge tax savings in getting set up that way. One thing I will say on the S corp is that strategy is best when it comes to active operating income, when you're like for travel agent or construction, things like that. But if you're just doing something like a passive investment, like a rental property or something like that, then in that case, the S corp would not be the way that you want to get set up. So all of this to say, and I'll just, plug our business here, but this is why it's important to seek professional advice from a CPA, from an attorney, maybe when it comes to some of the liability issues that we mentioned. So that is a service we provide, would be tax planning, and so we can kind of help you determine what entity structure makes the most sense for you and what's going to help you save the most in taxes.
Agreed. You should definitely value your professional advice. We can give you all kinds of tips on organizing and running your small business, but in the end, you want to focus on what is making you money and spending your time on that. You can put things in place where you still have all of your records and you have everything that's needed to run the business, and trust the people who are experts in knowing, like Nick, who knows all of the tax strategies and the tax planning, or me, with 30 years of experience doing small business accounting. It's going to take me a lot less time to do your accounting, than it would you. And you've just kind of got that relief of trust it to the experts, and you do what you do best, and let your professionals do what they do best.
Yeah. And, that frees up your time to really focus on, like you said, what makes your business money, and not have to, waste time getting caught up in the weeds of accounting if it's not your forte.
Absolutely. There's some nerds like us, that kind of stuff we enjoy doing. Most
Right.
people don't enjoy accounting. I kind of do.
Exactly. Awesome. Well, Mandy, anything else you'd like to touch on? I think this was great. I think we went through a lot of great info for small business owners and travel agents specifically. I really valued the discussion today. And I think if you're out there and you're a small business owner and you're trying to figure out, where to go from here, it's never too late to set up in a meeting with an accountant and get things organized and figure out the best strategy for you moving forward.
Thank you so much for joining us today, Nick. We really appreciate your time. Could you let our followers know how they can find you for all those awesome tax strategies?
Definitely. So our firm is Sullivan and Grantham. We're in Decatur, Texas. So feel free to give us a call, shoot us a message. We'd love to help get you in here for a client consultation. Also, we also have a YouTube podcast that we do. It's called Facts, Figures, and Fallacies from the Front Line. So feel free to give that a search on YouTube. And thank you again so much, Mandy, for having me. This was great.
All right. Thank you.